All right, guys. Okay, it's been forever. I haven't done a small video, and I prepared the post, so I'm gonna publish that. But in this post, I will put this video explaining all the charts I put in the post. So hopefully, maybe by verbally nuancing what I see in the charts, can make some more sense, and hopefully, well, it does there. So we could convey this critical concept there. I think I must have seen it when I did during my charts a while back there. But sometimes Kevin and I, we look so many charts and we see some relationships, and then okay, maybe we get sidetracked. The price is moving fast of something, and then we don't get around to it. But I think we're going to coin it the super capital rotation. So essentially, you've seen the charts where we've had a capital rotation event in favor of gold back in the 1930s when the stock market crashed. Then we had another one in the 1970s when the stock market crashed and gold outperformed the SPX. Same thing, or the SPX or the Dow Jones. This is the Dow Jones, guys, I have right here. Or the Dow Jones underperformed the metals, silver, oil, all that stuff. And the 2000s, we had another one here. And we're angling towards we're getting close to another one. So there is a breakdown there. There are some fundamental macro clues, evidence that suggests that the CRE that we're going to head into is something different. It's something that it's not like the 2000s. Often we look at the 2000s rollover of the stock market versus gold, but this is a stock market versus silver, and I'm going to explain to you right in a few seconds why I'm use silver mostly in this post. But because often we see the data, the closest CRE, and our eyes are focused on that, and then we don't have data going back 50 years, 60 years, 100 years, and so then okay, well, that's the data, so it's going to, the price is going to do what it did most recently. Well, while there is some credence to that recent price action, the macro landscape, whatever, like the Fed tools, whatever they do to manipulate the prices and all that stuff, the hedge funds, AI, all the narratives, guys, all of them. And you say, okay, well, maybe we're closer to 2001, but I think this is the macro pendulum swings are way, way, way bigger than this. And I have the chart lower. I'll show you there where it doesn't matter AI or whatever is a la mode there, whatever is like current in the current headline news of why it's different this time. I'll show you guys it's probably not different. Maybe the news headlines will be different, but the macro pendulum swings guiding these CREs, and in particular these super CREs, they're kind of baking in a little bit the trend there that's going to happen. So why am I going to use silver? Because silver, guys, is more free floating prior to 1970s than gold was. Remember, gold was pegged, and maybe I could just show you a gold chart. I didn't put that one in here. There, I'll just show you the gold chart. Okay, here, check it out. So here's the gold chart, and you'll see here it was pegged. But people think pegs that it's the person who pegs it that controls the price of gold. No, they're pegging it, but eventually, if the forces of the market are so strong that something's going to break, if they don't unpeg it, or there's going to create an arbitrage play and the market's going to force to unpeg it, then the peg is kind of an illusion, right? You think, they're giving you, there's control there, but is there really? So here, you see the peg for gold. Silver was dropping violently. That actually helped. People preserve their purchasing power probably more right here as gold, or at least make money in arbitrage play holding gold because it was pegged while your purchasing power was increasing, right? Purchasing power increasing, silver price decreasing. This actually helped people make a lot of money, the people holding gold here. But here you see as silver was going up and up, and I could overlay the oil chart, guys. Check this out. New price scale, put on the log scale. See, even oil, so oil, silver, all that stuff, guys. Those they're all tracking the same capital flows, so different fundamentals, different supply and demand mechanics. But look at that, oil and silver, they both track. And gold, if it wasn't pegged, it would probably track also here in 1945. It would have went up with silver, would have went up with oil, etc. So that's important when using ratio charts. And prior to 1971 with gold, you're kind of missing out on this granularity, right? This huge move down for silver and this move up for silver going up. You're hiding this information of silver was actually going up. And this is going to be very important because what I'm going to head into right next, it's important to know what was silver doing prior to the CRE here, this super CRE here in the 1970s. What was silver doing? What was the market doing? And silver was not going down, guys. Oil and silver were going up. They've been going up for decades. They went up. They were going up, guys, heading into a super CRE, this crescendo outperformance of silver, of oil, of gold, the greatest gains ever in those commodities, and probably not the soft commodities, guys. And I'm going to touch on that. I put some charts for, let's say, sugar. You got to be careful. It's not all commodities that will go bonkers, or that go bonkers leading into super CRE. And I'll go back to the evidence for that. So let me get back to the post here. I'll break this down step by step. So here's Dow divided by silver. I put here, this is where I think we are today, 1968. We'll know hindsight, how the patterns develop after, and then we'll situate ourselves better. But, right now, this is the Dow on the 2-month chart, breaking down below that, the cloud, below the 36 bi-monthly moving average, below a rising support line. Here, the momentum, the distance from that 36 bi-monthly candles, lower highs, and now we're going in below in negative territory after having a dip prior here. The similarities are uncanny. Same thing here. I could have maybe drawn this more acute, but here higher lows break down below the cloud, below the 36 bi-monthly, or I'll say the 36 period moving average. And look here, we're dipping below. So now we're below here. So we're hitting same structuring of weakness of the Dow. Even if the Dow's going up, and I'm going to show you the price of the Dow there, kept going up here. Silver price kept going up, but it wasn't able to go up as high. Does that ring a bell? We're seeing exactly the same thing today. The Dow's going up. Silver's going up. Oil's going up. Not oil. Gold's going up. The metals, those precious metals are going up. But they're not able, the stock market's not able to outpace it as it did before. Same setup as the 1960s. It's just uncanny, guys. And I think that's what instigated me to have to talk about this a little bit. So that's a setup from this chart. Okay? So now, just a little piece of evidence. I'm going to go into a lot more details in the following charts. All right, let's look at this one here. All right, so I squished up this previous chart. I put in the top pane. In the bottom pane here, what I decided to add, I wanted to overlay the Dow Jones, which is the blue line here, and then the silver price. So over long periods of time, guys, you'll see that because of the destruction of purchasing power, both this stuff goes up. It goes up and up and up. You think they're going up. They are going up. There's speculation. There's growth. It is going up. But what's holding the floor on all of this over very long periods of time is the destruction of your dollar, right? The printing of money, the total debt, all that stuff is keeping a floor nominally on that. Well, while that's fine, but we're trying to maximize this. We're trying to understand, what's like, we don't have a 100-year landscape, right? Time zones. We have a 10-year, 20-year, 5-year. We want to see which is going to be the better asset class. And remember, we have the dynamic portfolio manager, which will adjust it every month, guys. Will help you see where the bigger pie chart. I'll show you guys, for those who don't know. Here, dynamic portfolio manager, open a new tab. Here. So I'm going to show you the dynamic portfolio manager. And you'll see, guys, essentially, we're already, because gold is outperforming the stocks, right? Even if the stocks haven't faltered, so the stocks are still beating, the bonds. They're probably beating cash, but they're not beating gold. But gold is beating everything else. So you're 50% gold, etc. So that kind of tells you from a visual display where we are in the cycle. Eventually, when the stocks start faltering, gold will probably take its share. Stocks might be just 16%, and gold will have a bigger chunk. So we're on the onset of that. We're the setup's there for that. All right. Okay, there's a lot of details here. So All right, here's like, let's, what can I bring your attention here? Here's the first CRE here. It happened back here. Here's the 2001 CRE. So I'm not going to talk to you about the super CREs. I'm going to talk to you about right now just the smaller CREs. The 1929, 31, the rollover in the stock market. Here's the 2001 rollover. But then after that, after the first CRE, what we had is a period of the stocks going nowhere. Right here, I just put a cap here, a place where the price bottled below that. Here in the 2000s, just they kind of bottled below that. They weren't accelerating at the same speed. Silver was also putting some higher lows here, higher lows, probably another higher low here. Essentially, higher lows at the onset of this, but now again higher lows. Just to show you that after silver's huge drop here, silver's starting to put in these higher lows here, and trying to create this new up move for silver, a little floor under silver, which helps it go up there. So even here, we had the CRE, we had the Dow Jones going nowhere, we had silver going up, outperforming. Same thing here, CRE, silver's going up, outperforming. They're both going up together. And after, when the stock market broke out here, then after that, silver went flatline here. Here, the stock market broke out. Okay, silver had a blow off top, so corrected a lot more. But after that, it went sideways for that. But right now, after silver broke out here, maybe in the early 2024, gold in 2023, or even here can make a case back in the July 2020, right here, when silver broke out and gold broke out in June of 2019. This is happening here. It's like we're back in 1966, somewhere here. Silver is breaking out to the upside, having this crazy move up here. So here, look at my hand right here. I'm right there. Silver's going bonkers here. That is a pretty impressive move for silver. The stock market's also going up, right? Higher lows, higher lows. They're both going up together, guys. Look at that. Stock market's going up. Silver is going up also. So whether you take the starting point here in 2020, or you take the starting point in 2024 here, look at that. Silver's going up with the stock market. But if you go back to the chart on top here, the stock market's starting to roll over versus silver. And that's the big step, big observation there to start to think in the back of your mind there. So they're both going up together, but when the stock market starts faltering versus silver, it's a setup to a super CRE. Notice also here, and I think I'm going to go, I have a chart there that's going to zoom in on this. Silver, after this huge run up here, while they both go up together, silver corrects hard. I can't remember how much this is there, but this is at least 30-40%. Here's my silver chart. Let me bring it out. I'll go on the daily. Let me go in the 70s. Oh my God, okay, I'll go on the monthly. All right, remove drawings. That's like, some pretty impressive drawings here, just to show you some of the similitudes. I didn't put in the post, but you could see here the huge pattern, base, takeoff patterns, base, takeoff patterns. But look at this correction here. Let me just zoom in, just to show you there. Sometimes, the time frame is important. Silver corrected, and this on a monthly close basis, 48%, almost 50% over 42 months. Over 42 months, it corrected from peak to bottom. That's a pretty impressive long period of time there for silver to correct there, and a big amount. So you got to be, if that happens today there, 50% correction. Let me just grab that. It doesn't have to be this way, guys, but look, let's say we do correct. Look at that. My goodness. You could fit that in here. So silver price, let's say it rockets upwards. We hit that 57, 75, 100, wherever it is there. Maybe from on top. You could make a case that this longer term rising trend line here will get tested eventually there. Let me put the label on top. Why is it the bottom? Okay, because I went down. So I'll just move that. You could have a retest of this rising support line. That is crazy. But, on the instigation of this CRE, this super CRE, and I'll come back to it here, this first drop in the stock market there, that was a pretty big drop, right? So silver started correcting before stock market. Then the stock market just hanged in there. And then after that, it dropped. All right. That's how it played out back in the 70s. All right. Let's look at this one. Let's look at this one now. I added a little bit more labels. So here's a super CRE label I had on top here, super CRE label, just to show, to pop out there. You're gonna start noticing these similitudes as I go in with the details. So again, here we're potentially here. There could be a retest here. This is the period where when this goes back up here, that's silver going down 50%. That's the market going down maybe 30%, right? But the markets, that's it. The ratio is going up because the markets are going down and silver is going down. But the markets are going down just a little bit less than silver. It doesn't have to be that way, but you got to expect maybe some type of pullback. Often we just imagine lines going straight down, but you'll see there's retests. The market exaggerates to the downside. Then there's pullback, corrections, retests, gap fills, whatever you want to call it. It's never in a straight line. Here I added this huge important macro environment metric. It's the 10-year yields. So just to give you like this huge macro landscape there of what's happening, which could instigate this super capital rotation, and why this time it's different than the 2001s or the 1930s one, and it's more like the 70s. Look at that. I had the 10-year yields going back all the way to 1913. We had a peak here. And then after that, the yield, rates going down. What did we get here? We got the 1930s, 1929 mega bubble, right? With the yields going down. Look at that. The yields going down, peaking here. Yields going down. What do we get here? We got the 2001 dot-com bubble, right? Let me just move that up. So that's some big similitudes in between the CRE from the 1930 to this in the CRE from the early 2000s. It was amidst lowering rate cycle, lowering rates. So here we have the lowering rates, bottoming at 45. And guess what? They're starting to turn up, higher lows. We just bottomed right back here in 2020. Guess what? Higher lows so far. I don't know if it's going to be this acute, how it's going to play out exactly. Look, it's not going to play exactly out. But what I do know is we're doing higher highs, right? The yields, higher highs from this one. Like the further this price goes up, the yields, it's going to start doing higher highs from further back, right? Just like it did here. As it was doing higher lows, every time it did a high, it beat a high that was even further away, right? Further away, like doing that new uptrend, that arc support. So I call that the pressure buildup. The yields starting to turn upwards. It's creating that pressure for that super CRE, right? That's the macro backdrop to all of this. This is for me more important than AI, than all the other stuff you could pop into there. The rates guide a lot of things, right? And the rates going up, those 10-year yields are telling you that you're heading into an inflation cycle, right? The yields are telling you that the market's pricing in that inflation on that 10-year landscape. And if it be the 30-year yield chart, then longer term inflation, right? The market's actually putting in those yields in, carving out that chart because they're expecting that inflation, that destruction of purchasing power. So you need more higher yields for people to save their money more, to offset that, to balance things out. Here I kept the marker, that 1968 marker here, and look, I don't know exactly where we are. It's not exactly the same, but we could be anywhere in this region here. It depends how fast things accelerate, how things go sideways. But that's the environment we are in at the long term. And remember, in the 70s, even if it was inflation going up, there were huge recessions within it where the 10-year yields dropped massively, right? Here, 10-year yields dropped. It doesn't mean this line could 100% drop. The higher lows here could be somewhere a little like close to that bar, rising bar. It could be lower, but it will probably be higher lows, just like it did from the 50s onwards. It's gonna be higher lows until we crescendo maybe somewhere up here. I don't know where, 10, 12%, wherever it may land. The trend is up. So if you take a step back, so while we had one, two, three CREs, and this is the fourth one. From a macro landscape, this is nowhere close. This is not the 2000s type of CRE, right? It's not a 1930s type of CRE. This is a 1970s super capital rotation event, right? That's for me a big piece of evidence there that if you don't look past 1968 and you don't get those yields, you don't see the tendency, the trends leading up to that, you're going to miss that there. And then I think I have some more charts showing you more details, more observations about this right here. All right, so here's the stocks versus the silver price, the bi-monthly. And look at that. Here's the 1930s one, the first CRE. Strong move up in the stocks and a fast topping pattern, and down it went. Bam. Fast topping pattern, and down it went, creating a much bigger correction period or stagnation for the, well, yeah. This is the takeaway I wanted to tell you. Violent move up, fast turnover. CRE. Go to the 2000s. Fast move up, longer in duration, but acute. The rollover, though, at the top was as fast. It was very almost a V shape, right? Bam. Turned over really fast, the dot-com bubble one. And often that's, sometimes, with hindsight, we know there was a CRE there, capital rotation event, but sometimes Kevin and I were on the monthly chart and we say, man, how we would have played this in real time. It moves so fast that, sometimes you don't trust it. You think it's going to retest more. It's going to take more time to roll over, but sometimes it doesn't there. It's up and down, and it happens like that. So those again are similitudes between those two micro or regular CREs. But look at this super CRE setup. Look at this slow rounding top again. Look at this slow rounding top. I don't know if it's a pure head and shoulders one there. I could have drawn the neckline here instead of that longer rising support line. Here I have a longer rising support line. I could put a neckline here. But the idea is higher highs, lower highs. Higher highs, lower highs. You could call it a left shoulder, head, right shoulder. It's fine. I'm not a stickler for that type of structure. It doesn't really matter. But you're doing lower highs, breaking a rising neckline below the cloud, below that 36 bi-monthly moving average. And considering the rates are going up, right? Remember that the rates are going up. This is a slow rounding top that's been carving out. It's been taking many years for this to play out. Silver's going up in price. Gold's going up in price. The stock market's going up in price while all this is happening, right? But the stock market is not able to outpace, and that's key. So I keep repeating these observations, but they're important. So again, this is just a breakdown of this chart. I can't say they're uncannily the same. I don't even know if that's a word, but the setup, even in their price structure, the ways the markets are rolling out there, it's very similar to the late 1960s. Wow. Okay. Look at this one. Okay, I had to get this one off the internet. I have to it's from a Gold Charts R Us. Because, TradingView, as great as it is, it doesn't have all the data. We have ASA. So ASA starts about here, guys, 1968, just about here, ASA. And I'll show you lower there. But it was important to know, what did the miners do prior to the CRE, the super CRE? Were they super high and unwinding and then moving up, just like they did in the 2000s in that smaller CRE? If I'm to trust the Barron's Index, so I don't have the ASA, but now when I do my ASA charts, I will be able to imagine my head, look, they were bottoming, and they were exploding. In 1960, they were already moving up crazy. They had a breakout, moving up crazy prior to the super capital rotation event, guys. Keep that in mind. Prior to the super capital rotation event, they were flatlining and breaking out. And guess what they did today, guys? Back it up. Guess what they are doing today? Bottoming, going sideways, and exploding upwards. And you can make a case that they've been going upwards. The bottom was actually in 2015, but they've been trending upwards, just like gold, just like silver, higher lows, right? So here I'm starting to put these annotations here. Here's like, because of the barons, we know that it was sideways and up. It could even, I think, could even be lower here and then moving up even more, right? Even a more violent move. So I'm going to probably have to redraw that. The distance for moving average is probably coiled and tight. Remember, when the price goes sideways, the moving average is probably coiled and tight, exploding upwards. And here would most likely be super stretched from the moving average. Higher than here, I'm not sure. But it will be stretched. Reset, and then after that, another leg up, another low risk entry here, because the moving average is probably going to look like this right there. So I think we're close. We're somewhere here. I don't know where exactly there, but we're close to that peak in the minors, where this is not meant like, to say sell, 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 but we are getting close to that peak in the minors, where the low risk entry, of course, 100 super far away from us. I retook an analog of bar patterns just to show you what could happen here. So now I have a better situation. I did a post before and I wasn't sure quite where to fit my analog from the 70s. I started super low here, but essentially I think it hasn't even started. This bull run from the 70s that we see from 68 all the way to the peak in 1980, 81, that probably starts here, guys. So the first important correction, that 1968 correction, when silver goes down, right? Remember, stock markets go down, silver goes down, gold goes down, silver, like they all go down. The markets do a little bit better. It would look like that, and that'd be a beautiful, beautiful correction, man. Retesting a breakout line here, a descending breakout line here. Like, it'd be so beautiful to see that type of. I know people they want to hear this. If you're long and you don't want to hear that, it's going to be like some type of 40, 60, 70% correction here, but that is a possibility you must consider, especially if this is super CRE. If a gold stretch, silver starting to get stretched, you gotta expect these corrections. So we don't know how they're gonna play out, but this is 100% a possibility, and it's still a bull market, and it's going to be a bull era above this if the Dow Jones breaks down. And I have a chart below there just to show you that we will be in a bull era, as even if these crazy 70% corrections there, you'll still be in an overall bull market or bull era, even with these crazy corrections. And here, I didn't put it here in this post there, but I do have the ratio charts of the miners versus gold and miners versus silver. If this is to play out again in the 70s here, in this run up here, the miners outperform gold and silver, not by a lot, but they outperformed them. And if you select maybe the best miners, you'll get dividends. You'll outperform gold and silver better. But this is the final rally here. After this, it was over for the miners. It was over for them. The index of them, they did not outperform gold. They did not outperform silver. It was downhill from there, sideways and downhill. So after this huge correction here, wherever, let's say people decide to exit here, we'll try to find some exit points when we lose the daily chart, the weekly chart. We wait for this correction, no matter how it may play out, you wait for it to play out. Then you get back in somewhere here. And this run is going to be the last run probably for the miners in this bull era. I know the price keeps going up, but the price going up, if silver is outperforming you, like, what are you doing with the miners? You got to be honest there, right? Okay, let's go with the soft commodities. So that's the metals and the miners. They're really behaving like they did for that super CRE. But what were the soft commodities doing? Because I remember I've been doing a commodity rotation table for you guys. And the soft commodities are terrible. Most of them are terrible. I know sugar's down the drains, going down. A whole bunch there. They're severely underperforming the stock market. So soft commodities actually heading into the CRE there, the super CRE, where they did horrible. So focus here there, because that's like a lot of data. But remember, silver was going up here in the 1950s, right? Remember that chart from above? Gold, it was pegged, oil was going up. But the soft commodities were going down. Sugar was going down, heading into the CRE. It was going down, and it violently went up once the super capital rotation event was confirmed. And gold went ballistic, silver went ballistic, all that stuff went ballistic. The commodities, then they started going ballistic, and then they outperformed the stock market. They were the last ones to really get into this. maybe after like severe risks of I don't know, whatever, they started moving up. Here's a silver, like again, my silver chart that starts in 1972, so it was probably even lower here, 72, yeah, 60s, like we're somewhere down here. So at the start of the super CRE, price was going down, 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 and then violently shot up. Here's the 2000 CRE. So silver's already starting to go down, showing it's not as down, it's not going down as much as it did back like for decades and decades and decades. Here there was a move up, then went down. That's where sugar is today. It's not going up. So the similitudes, I don't know how low it's going to go before this violently rockets upwards, right? Even the 2000s, right? Before the CRE kicked in, and went violently upwards. Just don't know. But the soft commodities are following the blueprint, sugar at least, of the previous CREs and the previous super CRE, where they're not going up. They're not following silver. They're not following gold. They had a rally here, but right now they're going down, down, heading into that zone, right? Into that, where am I there again? Look, they're heading into that zone there. Are we potentially here? You know, they're heading into that zone. While gold and silver are going up, making that ratio go down, the soft commodities are doing what they previously did, and that's just going down. There'll be a play for sugar, all that, but once you get the CRE confirmed, that's probably going to be the play for silver, for sugar. And here's the Dow Jones, guys. This is the most important chart. Not the most important, but nothing happens until it fails. So here's 1968, starting to roll over. 1968, what was that arc again? It was the, whoops. Yeah, 1968. I just want to pop the silver chart. Yeah, 1968, I marked it because that was the peak. That's when silver started rolling over, right? So silver rolls over, market still goes up a little bit. You think it's game on, but no, the stock market follows suit, sniffing out whatever, silver sniffing out huge correction. Look, we haven't lost any rising support line. And yeah, that needs to fail, right? That needs to fail. But silver, you see here it failed before that rising support line failed, right? So silver also is running hot. Gold's running hot. We're gonna track it on the smaller time frames to see what happens. But the correction in silver and gold this time around, even if the markets, they managed to, stick around like they did in the late 60s a little bit more before really rolling over. That's, for me, we're closing in on that zone there. We're closing on this gap there. We're closing in on it. And of course, I could have put a whole bunch of other evidence. I could have put the, the yield curve charts, the 10 minus the 2 starting to go upwards, the unemployment rate starting to go upwards. I'm repeating myself, but all that stuff is stuff that you see on these turns. It hasn't happened yet, but the fact that this is already rolling over should be a big, big warning sign that I don't know if it's going to play exactly like this, but we're in that danger zone where one last respite for the, well, I can't even say that for the Dow Jones there. We got to just wait there. But once the gold and silver do roll over, then watch closely the Dow to see how it behaves. And if it can't break out and it starts following suit, then we got a super CRE on our hands, guys. All right, 33 minutes. I don't want to keep it too long. Put your comments below and let me know if you like this. Thanks, guys.